The city is still wrapped in the cool, quiet dark of pre-session. And across the landscape, lights begin to appear one by one in the windows of tall towers. In one of these rooms, a single desk lamp casts a warm glow. It illuminates a person sitting before a bank of screens, their face calm and focused. Elsewhere, someone on an early train opens a trading application on their phone, the digital charts a stark contrast to the waking world outside. This is the modern habitat of the day trader. They are a unique species, adapted to a world that moves in seconds and minutes. Their goal is not to hold on to something for years, but to capture small, fleeting movements in price over and over again, all within the span of a single day. This practice can seem complex and frantic, but it is a relatively recent evolution in the long history of commerce. For centuries, trading was slower and more deliberate, tied to physical goods and seasonal cycles. At its very core, the intricate dance of market prices is governed by a beautifully simple principle: supply and demand. This is not a complex financial formula, but a natural law of human interaction. Imagine a small town market with only 10 fresh-baked loaves of bread for sale. If 20 people arrive, all wanting a loaf, people will pay more to ensure they get one. The demand is high, but the supply is low. The price naturally rises. Conversely, if the baker brings 100 loaves and only 10 customers show up, the price must fall to sell before it goes stale. Here, supply is high and demand low, so the price falls. The same elemental force plays every second in global markets, just larger and faster. The bread might be shares of a company, a currency like the euro, a commodity like oil. Good news triggers a rush of buyers, a surge in demand. With limited shares at that price, buyers bid higher to attract sellers. The price climbs. Day traders watch for this clear signal from the herd. Bad news can cause a wave of fear. Sellers flood the market and prices plummet. To the untrained eye, a financial chart is just a jagged, meaningless line. But to a trader, this chart is a language, a story of buyers and sellers, moment by moment. Each movement up or down is a word in a sentence. Each pattern is a paragraph that tells of fear, greed, and indecision. Price action is the art of observing price itself, without clutter. We see where the market has been to anticipate where it might go. The most important features are zones of supply and demand. A demand zone, or support, is where buyers previously overwhelmed sellers and pushed price higher. A floor. A supply zone, or resistance, is where sellers flooded the market. A ceiling. A single candlestick tells the story of a minute, or 5. Long green, buyers in control. Long red, sellers dominate. Doji, a stalemate. At key zones, these candles confirm strength, the cue to act or stand aside. The unseen partner, understanding and managing risk. In day trading, every single trade has a constant companion: risk. It is the shadow that follows every potential reward. Newcomers fixate on gains. Pros respect risk. Losses are not just possible, they are inevitable.
The key is not avoiding losses, but keeping them small, manageable, and planned.
The most fundamental tool is the stop-loss order, an automatic exit if price moves against you. Buy at 100, stop at 99. If price hits 99, you exit, limiting loss to $1 per share. Position sizing. Many pros risk no more than 1% per idea. With $10,000, 1% risk equals $100 per trade. This math protects weeks of work and keeps you in the game. Ultimately, managing risk is managing emotion, fear, and greed. A solid risk plan, Predefined stops and clear targets removes heat from decisions. Make the plan when calm. Execute it with discipline. From shouting pits to silent clicks. A brief history of speed. Not so long ago, the market was a roar. On the floors of New York and Chicago, traders stood shoulder to shoulder in octagonal pits, shouting and signaling. They scribbled furiously on paper tickets. Open outcry. Trading depended on physical presence. Barriers were immense. In the late 20th century, electronic systems changed everything. Personal computers and the internet beamed market data into homes. Online brokerages let individuals click to trade. The pit's roar faded to the hum of servers. Wall Street's domain opened to anyone with a computer and a connection. Execution moved from minutes to milliseconds. Tools evolved, principles did not. Electronic speed amplified both gains and losses. The path forward? Cultivating skill through discipline. Day trading can feel like a turbulent ocean. The way through is not chasing storms, but simple actions repeated with discipline. It is not a get-rich-quick scheme. It is a craft, honed over thousands of hours of deliberate practice. Study supply and demand, learn price action, and respect risk. Anna began with a small account, spending months just watching the market. She marked zones and built a visual library of reactions. Then she practiced in a simulator, the Trader's Flight Simulator. She journaled every trade, why, outcome, what to improve. Only after consistency did she risk real money, starting tiny, then growing slowly. Strip away hype, trading rewards, discipline, and respects risk. It is, in the end, a journey of self-discovery, knowing that today, 2025-10-30 will present its own challenges and opportunities.